Dan Passarelli here. How are you feeling today? I would like to make sure that you can hear me. Please go to the Q&A box and let me know that you can hear me. Just give me a big old yes, please. Yes, you can hear me? Hit that questions box. All right. Thank you, Enrich and Anonymous. Excellent, excellent, excellent. Okay, so today we're going to talk about protecting long-term stock investments using collars. This is a very timely conversation, and I'm glad you joined me, and I bet you are too. Now, before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investorservices@theocc.com. All right, so if you're not familiar with me, who I am, allow me to introduce myself. My name is Dan Passarelli, and I'm an author, a trader. I'm the founder of Market Taker Mentoring, which is the global leader in option trader education. I am a trading industry collaborator. Sorry, I've worked with every major options exchange literally in the world, and many of the options brokerage firms, at least the good ones, like Firstrade here. And I'm a family man, father of two now grown children, and husband to my wife, Kathleen. And I like to do lots of fun stuff. I'm a runner, not very fast, but I'm a runner. Foodie, I love to eat, as you could see if the camera showed my whole body. I enjoy traveling, been all over the world together with my family, and I am also a musician. Now, enough about me. Let's talk about what can help you. So options can be used to help protect long-term holdings like stocks and ETFs and theoretically even futures. But strategy must be structured correctly. Otherwise, it can really do you a disservice. So in order to understand collars, what we first have to do is understand protective puts. So a protective put is when an investor owns shares of stock and then buys a put, typically out of the money, to protect that stock. And it's very much like an insurance policy. If you own a $50,000 car and you take out an insurance policy with full coverage, if you crash your car, you get a new $50,000 car. Now, there might be a deductible, and we're going to talk about that. And there is definitely a premium, and we're going to talk about that. But it's a pretty darn good analogy. So what you're doing when you buy a put to protect your stock is you're limiting your risk. But I'm not going to lie to you, it's pretty expensive. So we want to limit our downside risk potential on a stock that we own. We buy a put on the stock, and then the put owner, that would be us in this example, will then have the right to sell the stock at an agreed upon price, which is called the strike price, until the expiration date. So let's look at an example of how all this works. Let's say we own 100 shares of the SPY ETF. That's the ETF on the S&P 500 at $551 a share. So if we want to protect that, we could buy the September 541 put at $6.89 right here. So we would just go to our option chain here in Firstrade, pull up type in SPY, go over to the left-hand side, which is the put side. That's all I have shown here so that it can be nice and big and you can see it clearly. And we would just click on the ask and we could enter that order. Okay, simple, right? Now, how does this actually really mechanically work? All right, Well, the dotted line here is just owning the shares of Spiders. And if we just own the shares of Spiders, I mean, that is a pretty simple thing to understand. If Spiders are at 551 and it goes up by a penny, then great, we make a penny. It goes down by a penny or a dollar, okay, we lose a penny or a dollar. Very simple. But when we buy the put, it fundamentally alters our risk structure. This is the 541. And by the way, what this is called a P&L diagram, if you're not familiar with that. The vertical axis is your P&L, which is your profit or loss. And the horizontal axis is the price of SPY at expiration, which in this case would be the third Friday of September. Okay, so if at expiration, on the third Friday of September, SPY is above the strike price, meaning didn't go down $10. It's still above the strike price. Well, guess what? Because the put gives us the right to sell those shares at 541. If Spiders are above 541, we're not going to exercise that right? We wouldn't want to sell something at 541 if it's trading at 560, would we? Of course not. So basically what happens is that put expires and we lose the $6.89 premium. And it's called premium just like your insurance premium. Okay, same word, not by a coincidence either. But, hey, that's okay. If Spiders, I mean, that's what? August, September, 7 weeks from now, if Spiders are up at 560, 570, 580, then okay, we gave up $6.89, which, I mean, actually is kind of a lot. I'll talk more about that in a second, but we still have the shares and we could still be making money. Now, if Spiders go down and are trading below 541 at expiration, then that's where our insurance policy kicks in. We can exercise that put, exercise our right to sell Spiders at 541, and our loss is limited. So what is the most that we could lose on this position? Because if we don't have the put, we can lose a lot. I mean, if there's a market crash, we could lose pretty significantly. But here we have limited risk. So the most we can lose is 3.1%. And we have that protection for 50 days, however long it is until September expiration. Now, how do I come up with 3.1%? Okay, well, first, if Spiders are at 551 and they go down to 541, well, we'd sell it at 541 and our loss is protected at that point. We're out. If it goes to 530, 520, 510, God forbid, 500, we're selling at 541. So the most we can lose on the shares is $10. But we also have that cost, the premium of our insurance policy. So we would lose $10 minus $6.89 is $16.89. That's the most we could possibly lose. As a percent, that's just 551 minus 543 plus 689, that's 1689. And then just divide that by where the shares were when we put this position on. So that's the benefit of how we're protected. But what is our cost? Well, our cost is that $6.89. That's gone either way. So if we're making money on the shares, or if the shares just sit there even, or if it goes down, like that cost factors in no matter what happens. So the best case scenario is we still own the shares go up in value, great, but we're still giving up 1.25%, 689 divided by 551. Okay. Does that all make sense? Give me a big old yes if that makes sense. And if you have questions, give me that question. Yes? You've seen my last Firstrade presentation. You know that. Thank you, Raul. Thank you, Maximo. Nice to see you. I think you were here last time, weren't you? Thanks, Keith. Good. That's great. All right. Excellent. So the key implications here. We're giving up 1.25% regardless. And that's for 50 days. But here's the thing. Like 1.25%, you know, not the end of the world. Fine, really. But that's only for 50 days. What about all the other days of the year? In fact, if you take 50 if you take 365 divided by 50, you'll see that there are roughly 14 50-day periods in a year. Is that correct? My math right? 365 divided by 50. No, there's 7.3. Oh my goodness. That's crazy. Hold on a second. Hold on a second. There's about 7 50-day periods in a year. So times 1.25. Okay, so that's 9.25%. Never mind the man behind the curtain. There are roughly 7 50-day periods in a year. So if we were to buy a 50-day put, wait till it expires, buy another one, wait till it expires, buy another one, we'd actually lose 9.125% a year to carry a position like this year round. How much do you make statistically in the long run with the old buy and hold strategy? You make 8 to 10%. So basically, in the long run, you'd be just guaranteed to break even. You might as well put your money in a CD. You can get a 5% interest rate now. So because you can't predict the future, you don't know when you're going to need the put. If you did, I mean, geez Louise, you wouldn't need option trading to begin with, right? If you could see the future. So because you don't really know when you're going to need the put, if you're going to use something like this, you would want it year round. So really, this is kind of a terrible way to hedge, isn't it? The expensive puts can be creatively overcome, however. Covered calls can help finance the put. So right now, what we have to do is we have to talk about covered calls. A covered call is when an investor owns shares of stock and then sells a higher strike out of the money call short. So the idea here is with the put, we're paying a premium for the protection. With the call, we're collecting a premium. But that comes at a trade-off. We limit our upside participation. So let's take a look at this. The rationale for covered calls, we want to generate income, and we're okay limiting upside profit potential. So we're going to sell a call option on the stock, and the call seller, which in this example is us, the call seller will then have the obligation to sell the stock at the agreed upon price, the strike price, until the expiration date. And in return for that, of course, we get the premium. We become the insurance company in a way. So here, now we'd be looking at the left side of the option chain. Let's say we own 100 shares of Spiders at 551, and we sell one September 561 call at $8.33 a share. Now, by the way, and I'm breaking this down to the real basics here. If you if you buy one put or sell one call or whatever, any option, stock option or ETF option, they typically represent the rights on 100 shares of the underlying. So if I own 100 shares of Spiders, I would buy one put, I would sell one call. Okay, makes sense? So here we would just pull up our Firstrade option chain, click on the bid, and we'd be selling the shares, or we'd be selling the call. All right, so how does this work? Okay, well here, if we just own the shares, that's the solid black line here. However, if we add the call to that position, the 561 strike call to that position, then it becomes like this dark green line, like an upside down hockey stick. So, okay, we have the obligation here to sell our shares to whoever owns this call, because remember, we're selling this. We're selling it literally to someone. We're creating a short contract. For every short contract, there's a long contract. So there's someone in the world who has the right to buy our stock from us at $561 a share. Now, if Spiders are below $561, that person would not want to buy it from us at $561. That person, I mean, if it's trading at like 540, that person would just go in the market and buy it at 540, right? So what that means is at expiration, if the shares are below 561, we get to keep the $8.33. And so if the shares are below 561, we always outperform by $8.33. Even if we lose, even if the shares go down, like if it goes down to like, you know, 540 or whatever, we still only lose a little bit. We lose $8, or, you know, we get that $8.33. Now, if the shares are above 561, what happens? Well, first of all, we'd make $10 on the shares because it goes from 551 to 561. That's 10 bucks. But then we're going to be selling it at 561. So we make $10, and here, let's just, you know, get back to this. We make $10. Here, let's go to this slide first. We make $10 on the shares, the stock rise, plus the call premium of $8.33. So that's $10 plus $8.33. The most we can make is $18.33, which divided by 551 is 3.3%. That's our maximum profit. Now, that said, what is our maximum loss? Well, I mean, look, if the Spiders go down, we still own the shares. And when you own shares of something, if it goes down, you can lose as far down as it goes. But we always outperform by $8.33. We're bringing in we're bringing in 1.5%. That's 833 divided by 551 over that 50 days. Now, you know, if you think about it, the premium is 1.5% for 50 days. What was it? It was about there's about 7.3 50-day periods in a year, right? So 7.3 times 1.5%. Wow, we actually would outperform the market by 10.95%, presuming our shares don't get called away. Okay. And that's true if the market stays the same, goes up a little bit, even if it goes down, even if we lose money, we still do almost 11% better than everybody else. So we collect the premium, we have the downside risk, and if the shares go up above the strike price, we might have to sell the shares. Does that all make sense? Are you already familiar with covered calls? By the way, if you are not, I actually wrote a strategy guide on covered calls. It's called How the Smart Money Invests. 97% of investors still don't use this simple income building strategy. So you can learn to trade like the smart money. And you can do that just by going to markettaker.com/covered. Market is in stock market, taker is in take what is rightfully yours, markettaker.com/covered, and grab this ebook. Even if you are already familiar with covered calls, do it anyway, read it. You might pick something up in there that you didn't already know. All right, that is my gift to you. It is free. It doesn't cost you anything. So this brings us to collars. A collar is a strategy that can help protect long stock or ETFs or futures at a very low cost. In fact, it might not cost you anything. This is an investor-oriented strategy, not for what I would say option traders, but for investors. And most of the traders I know are also investors. Now, this collar is a really useful strategy. It does come with the trade-off. So let's examine it. With the collar, we own shares of a stock or ETF or whatever. We sell an out of the money call, which is a covered call, and we buy an out of the money put, which is a protective put. So we're basically just combining a protective put with a covered call. So we limit our risk, but we also limit our reward, right? Because remember the covered call P&L diagram, if it goes up above a certain price, you stop profiting, right? So the rationale for the collar is we want to limit our downside risk potential on a stock or ETF that's owned. So we buy a protected put, sell a covered call to help finance the put, and that's really the key here. We will have the right to sell the stock at an agreed upon price, the put strike price, until the expiration date. And we might get assigned on the call and have to sell the stock if it goes higher. So let's look at an example here. Here I've got the complete option chain in front of you, both sides. And you can do this by simply going to your Firstrade brokerage account, typing in and click on options, type in the stock or ETF symbol, and then click on option chain. And then when you get to option chain, I made it easy and I clicked on just out of the money, OTM. So then there's fewer numbers to busy up our screen here. Okay, so this is how this works. We own 100 shares of SPY at 551. And we're going to do both of those trades that we just talked about. We're going to buy the 541 put at 689 and at the same time sell the March. Oh, actually, March. Oh no, these are September's. Yeah, these are September's. Oh, sorry about that. It doesn't really matter. We're going to sell these at $8.33. So now look, this is really important here. We're paying $6.89 for the protection. And we're collecting $8.33. $8.33 that is going into our pocket minus $6.89 that we're paying out means we're actually taking in a credit of $1.44 to execute this collar. Interesting, right? Now that's something that doesn't always happen, and I'll share why that might happen in just a minute. Okay, so we own the shares. We bought the put that we talked about before. We sold the call that we talked about before. We took in a total credit of $1.44. Here, the dotted line is the just simply owning the shares. And this, kind of like stretched out Z, I guess you might say, is the collar position. Okay, so if SPY ends up between the two strike prices at expiration, what happens? Well, we're not going to exercise our right to sell it at 541 if we're still around 550. And nobody's going to want to buy the spiders from us at 561 if it's at 550. So both of the options would expire, they would go away, but we get to keep that $1.44 credit. So we actually slightly outperform owning the stock or owning the shares if we're between the two strike prices at expiration in this case. Now, that's only because in this case, it is a credit. And one of the reasons why it's a credit is because the interest rates are higher now. That makes calls worth a little bit more and puts worth a little bit less. And so, like, this is actually a really good time to be doing collars because of that, because of the interest rate and how row affects the, not the skew, but you know, the calls and the puts independent of each other. All right. So if we're below 541, what happens? Okay. Well, here's the idea. If we're below 541, we would lose 10 bucks on the shares, 541 or 551 minus 541, we'd lose 10 bucks. But and then we would exercise our put and sell our shares, so we can't lose any more than that. But we actually don't lose the full 10 bucks. We only lose $8.54 because we took in a $1.44 credit. So we can only lose 1.55%. Okay. What if it goes up? What if turns out we didn't need that protection? Well, I mean, look, if it goes up just to 561, fine, no problem. But if it goes up above 561, we could be limiting our upside. How limited is it? Well, if it goes from 551 to 561, we'd make $10 on the shares. But we also have that $1.44 credit. So we'd actually have a maximum profit of $11.44. That divided by 551 is 2.1%. So we have that limitation for 50 days. Now, on the one hand, it sounds like, boy, that limitation really stinks, doesn't it? Because if I'm going to try and make 10% a year, I mean, that's only 2%-ish, right? Going up 10 bucks on a $551 ETF, that's only about 2%. So maybe that's a problem. Well, it doesn't have to be. Because, look, after these expire 50 days from now, you know what we'll do? We could put this on again, but at different strike prices, right? Or we can even do what's called an adjustment and buy back those 561 calls and do something called rolling up to maybe the 565 calls or 570 calls. So we've got a lot more flexibility than this very introductory discussion. So like I said, in this case, because interest rates are higher than they've been in 20 years at the moment, we're able to put on the collar for a credit. Because if you think about row, and a lot of people don't talk about row, when I said I was an author, the book I wrote is Trading Option Greeks. So that's kind of one of the things that I specialize in is the option Greeks. Row, what happens is, if you think about it, if I were to buy 100 shares at 551, it would cost me about $55,000. So there's an interest rate component with that, right? Because I could just go and take that $55,000, put it in a 5% CD and earn 5% on it. So I'm like, you know, I have an opportunity cost of 5% if I buy those shares. So if I buy a call, if I were to buy a call for $8 or whatever, I'm not tying up $55,000. I'm tying up $800. So I've still got that cash and I could go put it in a 5% CD. So that makes calls more valuable because I can have that upside exposure. I can make money if the shares go up and still make 5% in a CD. So that's the reason why row works. And that's the reason why when interest rates are higher, call prices go up and put prices go down. So, I never really thought about it until right now, actually, but it's pretty interesting that a time when you would be more likely to put on a collar on an ETF, like the whole market, like this, spiders, probably is in a situation where interest rates are high and we're looking at potentially cutting them if employment, if unemployment rate goes up or the employment rate goes down, which for those of you who are watching this live is actually what happened today. So this is actually a really perfectly timed presentation. Coincidence. All right, so with our example, that was using the same strike, $10 lower on the put, $10 higher on the call. But because we're taking in a credit, like we don't really need to take in a credit. I mean, sure, it's great, you make an extra buck, 1.2% or whatever it was over the next 50 days. Great. Whoop-de-doo, though. What I would really rather have is a better deductible. Now, I said I was going to talk about this idea of a deductible. And the deductible is this. When you have insurance on your car, it's a $50,000 car. Maybe you have a $2,000 deductible. What does that mean? It means the first $2,000 of loss is on you, right? If you have a bigger deductible, if the first $5,000 is on you, you probably have a smaller premium. If you have a lower deductible, it's just $500, you'll have a bigger premium. It works exactly the same way with options. The deductible is which strike price you choose. Here, if the shares are at 551 and it goes to 541, the first $10 is on me. It's a $10 deductible. Okay? But it doesn't have to be. Because I'm taking in a credit already, like I don't necessarily need that credit. What I need is a lower deductible. I need better insurance. So instead of buying the 541 puts, I could look at the 543 puts, a higher strike, which means only the first $8 is on me. It's an $8 deductible instead of $10 deductible. In fact, I might be able to do the 544 or 545 puts. More room to run to the upside, better protection to the downside. So as far as economics and timing goes, collars can be established sometimes at a debit when interest rates are lower, a credit, which in this example we could do, or close to no cost at all. Collars are often established longer term. Now I'm using 50 days in an example, but a lot of times, and you can often do these even better when we go out further in time, like 6 months, 9 months, a year even, right? And we can still have a low cost or still have a credit. In fact, it could even end up better. So here, let's look at a different example here. We'll look at shares of Apple. So this is using the September. I took the screenshot the day after I took the other screenshot, so it's 49 days until expiration for the September options. Shares of Apple at $2 or $217.25, right? We are going to buy the put strike that is about $17.25 lower, the 200 strike put. Buy those at 281. We're going to sell the call strike in this collar a little over $17, about $18, $17.75, I guess, higher. So pretty balanced. The put strike and the call strike are equidistant from the shares. We're able to sell those at $3.10. All right, so we're able to put this on for a credit as well, which is great. So this is the 49-day collar, 29-cent credit. What if we went out another 6 months to the Marches? Well, there are several considerations here. First of all, the shares can move a great deal more in what's 6 months, 180 days plus 50 days is 230 days, right? The shares can move a lot more in 230 days than they can in 49 days. Oh, 231 days. Yeah, there it is right there. So, okay, if they can move more, what we really want to do is we want to at least have our call strike higher because we want to give it more room to run to the upside. And that's what we call it in the business, room to run. We don't want to limit our upside, so we definitely want to sell a higher call strike. Now, here I chose just to go with equidistant call and put strikes, but to tell you the truth, in reality, I probably wouldn't. If I could get $10.70 for the 240 calls, and if that's the call strike I was comfortable selling, I would probably buy like the 205 strike puts. Heck, you could even do the 210 puts and give up $1.15, right? 1185 minus 1070 is $1.15. Doesn't matter. Or have a 70-cent credit with the 205 strike. Or maybe even sell a higher call strike. I mean, we'd have to look at a charts of Apple. What I like to do when I'm setting call strikes, whether it's on a straight covered call or a covered call that's part of a collar, is I like to see where resistance is. If I think that Apple won't get up above resistance, then I'm very comfortable selling a call strike at or above resistance. So I guess probably the best way to do this is see where resistance is, see what call strike that corresponds to on your time horizon. Here, using the Marches, we're covering all the way through the election, all the way through probably the first and or second interest rate cuts, covering plenty of time. So I would look at resistance, see how much I can collect for a call strike at or just above resistance. And then I would buy the put strike, whatever I could pay to get a zero cost collar. So if resistance is at 240, okay, I'd collect $10.70. I'd probably buy the 205 puts then. And now notice the reason why I chose to use equidistant strikes here is to keep this sort of apples to apples. If we go back to the 49-day ones, we collect 29-cent credit, keeping the strikes equidistant, but a little wider, because we're adding another 6 months of interest rate components affecting the call price relative to the put price, we get a much bigger credit. We get a $3.75 credit. This is a really, really useful strategy. Now, to be fair, once interest rates start coming down, we're going to see the call prices come down and the put prices come up relative to each other, which will affect the cost of your collar, by the way. Those of you who are pretty experienced and use the Greeks, but you never thought you'd be thinking about row, did you? So if we compare that 231-day collar just to a 231-day put, instead of collecting $3.75, we're paying $6.95, which comes out to, well, let's see here. From as a percentage basis, that's 6.95 divided by 217.25. We're giving up 3.2% instead of making 1.5% or so. Okay. So collars can be established at, oh, wait a second. All right. So to wrap up, and then we're going to go and do some Q&A here, if you'd like. Options can provide protection, but they're really, really expensive insurance. So we need to have a way to manage the cost of the protective put, and we can use collars to offset the cost of the put. All right. So that is everything. What questions can I answer for you about collars? What questions can I answer for you about collars? Any final questions before we call it a day here? Anybody? There we go. Does a collar have any other names? The option component of it, so short call and the long put, can be referred to as a risk reversal. Typically, I mean, I guess in general terms, it probably doesn't matter if you own the stock or not. But for me, and we're getting like really technical here, I would say the collar is the 3-part position: long stock, long put, short call. Whereas the risk reversal is long put, short call being added to the shares. But outside of that, yeah, no, I think those are the only, I think that's the only other name. What characteristic of a stock would you use this strategy on? That is a great question, John. So one useful scenario for this is what money managers and advisors call a concentrated wealth position. So say you used to work for, ABC Corporation that makes widgets. All right. And you were a big shot there. And so they gave you a bunch of stock in ABC Corporation. And you got a lockup period and you're not able to sell it or something, or you don't want to sell it, maybe, I guess, right? You don't want to sell it. So what you would do is, because that's like, your future really depends on that, because you have a concentrated amount of your wealth in it, that would be a really, really good scenario to use collar. But that brings us to a very important point here. If you can't or don't want to sell the shares, then you're going to have to manage the short call component of this. Because here's one thing that I didn't get into because I wanted to keep this presentation pretty basic, but now it's Q&A part, so it's fair game. when I talk about, okay, if you own this put strike, you would exercise the puts and sell the shares at 541. Well, you don't have to do that. The lower the shares go, the higher the price of the put. So I don't have to exercise that put. I just have to sell that put before expiration. So if I have a situation where I don't want to sell the stock or shares or whatever, I would just simply sell the put. And if the shares are going down, the put gets more valuable, the calls get less valuable. At that time, I would also buy back the call. You know, maybe it might be just trading for a nickel at that point. And leaving a nickel on the table is sometimes, you know, it can be like, it can be the smartest thing you ever do is to close out a call at a nickel, because if it ends up turning around and going back up, then worst of both worlds, right? But if the shares go up, and this is whether it's a concentrated wealth position or not, if you don't want to sell those shares, like when you're short the call, you've the obligation to sell the stock if the long decides to exercise. So you don't have a choice. You will have to sell the shares if it's above the call strike at expiration. So you're going to have to close that call strike. And that might be at a loss, and that's fine. That's sort of the deal you made with that profit and loss diagram. You're still going to make money on the shares. You're still going to reach your maximum profit potential. But I would say if those shares if that call strike gets in the money, you want to start looking at closing or adjusting at least the call strike. All right. Very, very good question. Please show again the slide. Oh, for the ebook. Yeah. And please, that's my gift to you. It is complimentary. markettaker.com/covered. markettaker.com/covered. So markettaker.com/covered. I got you covered. There you go. You are welcome, John. All right, folks. Well, that is everything that we have to talk about today. Thank you for joining me. I hope that was valuable to you. And it is definitely a valuable strategy under the right circumstances. And now it's another tool that you have in your toolbox. All right. This is Dan Passarelli. Have a great rest of your day and trade smart.